You have probably seen headlines like Toronto condos are down, investor bargains, buy when prices are low. But here's the twist. Many condo units are actually cash flow negative right now. And if you don't know what is going on into that, you could be setting up yourself for a failure. So let's unpack what is going on. Hello everyone, my name is Parth Soni. I'm a local realtor in Waterloo region, helping my clients in Waterloo region and also in Toronto downtown. Today we are diving into a question: is it a time to buy the dip in the Toronto investment condo? Now we will break down the numbers, the risk, and also the opportunities and what it means for you, whether you're a first-time investor or a savvy investor or just curious about it. The classic idea of buying the dip feels like it might apply to Toronto condos right now, especially prices have corrected from peak. We have seen roughly between 20 to 30% depending on which neighborhood you are going in. But here's the article which I found, which is very interesting. Everyone should look at it. It argues whether buying in this market makes sense or not. Breakdown like a one bedroom which is listed in Court downtown for $619,000 with a 4% of mortgage with 30 year of amortization, condo fees, taxes, and everything in that could cost you roughly about $3,350 a month. And a typical rent for that might be roughly about $2,600. So that is roughly about $750 before taxes, vacancy, and repair in terms of negative cash flow. Now let's take an example. It drops to 3.25%. You will still lose $540 a month according to this. And most of the time people argue like they are not buying for cash flow, they are only buying for appreciation and things like that. But make sure when you are buying only for appreciation, you are betting against the housing market or you're betting against the market, I would say. And not many investors out there can afford roughly $600 to $700 a negative cash flow every month. And to make this more affordable, the break-even interest rate would need to be around 1.1%, or you would dramatically need to lower the price to $423,000 to make the math work. And there is also a good report from Urban Nation. Again, it's a little bit older last year report, but it's still valid in today's market as well, which says that many condo unit with mortgages are cash flow negative, and the resale market and rental is in very tough shape. If you are an investor or planning to get into an investor, I would highly recommend to check out rentals.ca. It will give you a good idea of how the rental market is performing, and for past 12 months I believe it's going on a negative trajectory. So let's see what is changed and why this matters and why this is happening. So there are a couple of reasons for it. The very first one on this one is the higher interest rate. Now, mortgage services costs have jumped up, meaning the cost of holding that condo has increased significantly. And many times when people purchase this condo back in 2020, 2021, thinking like the mortgage is very low, when mortgages were at sub 2%, right now it's literally doubled. The other thing not many investors know about this is the maintenance and fees is rising day by day. Now, in this article, it highlights that the maintenance fees and the contribution to the reserve fund are rising. Example, for many buildings, the average fee increase was roughly about 5.1% year over year, and the reserve fund contribution was 11.8% in GTA. The third factor in this one is the oversupply and a softer rental demand. Now, many condos built during the low interest rate era are now completing, adding supply to the resale and rental market. At the same time, rental demand, particularly from non-permanent and resident and also from student, has reduced. And that creates pressure on rents and occupancy. The other factor in this is the institutional competition. Now, big rental developers and institutions have scale, favorable financing, and can operate more efficiently, making it harder for small investors like mom and pop investors or small condo owners to compete with them. You might have seen like many purpose built rentals are providing 1 month free on a 12-month lease or something like that, or Wi-Fi or some sort of an uh, things which many small investor cannot compete with. The last factor in this is the changing buyer or the investor behavior. Now, the thesis for many condo investors in recent year was not just rental income but appreciation or leverage, especially through pre-construction pre-sales. And if you know anything about the market, that model is not working right now. Those people who are only betting on appreciation are having heavy losses. So let's check out what it means for you. Now, if you're thinking about buying a condo in Toronto or in GTA as an investment, you need to have a crystal clear idea of what the rent could look like in that particular neighborhood or that particular subdivision. What is your holding cost will look like, and what is your future plan in terms of a long term? You also need to consider about the vacancy rate, repairs, renovation, condo fees, taxes, and so many things. You also have to consider, like, are you buying in a building with a strong fundamentals like good design, layout, amenities, management, or you are just buying because the price feels right or price feels low as of right now? And just to give you an idea, if you're someone who's purchasing in Toronto downtown, every building on the same street could be very different than the other building. So make sure you work with someone who knows about the building, particularly one in which you want to buy, so they can advise you better. Now, according to this article, like, yes, the long-term supply constraint may eventually matter. Example, like fewer new condos being built may mean scarcity in a years ahead. But for today's small investor, the risk to reward ratio is very high. And I will also make another video. If you are someone who is able to financially afford a condo, why it makes sense to buy right now because of this particular thing which I just discussed about not many buildings coming up into the market or breaking the ground. So we may see a strong demand sometime in 2029 and 2030. But till then, you just have need to be able to afford that. And there are some alternatives and strategies as well. So what you should do instead, or how should you adjust your thinking? And here are a few ideas. Now, considering a long-term horizon, if your objective is 10 to 15 years plus, then you should be able to manage your expectation and can move forward with the investment condo that you are planning to buy. But make sure that you are comfortable with the downsides as well, what you have just discussed. Focus on location, building quality, and the unit layout. I'm a big fan of unit layout. Like, make sure layout need to make sense, and especially for condos, if you're buying a poorly designed small unit in an oversupplied building, that your risk will increases dramatically. You can explore other neighborhoods like midtown, emerging areas versus ultra luxury core downtown areas. Now, some reports suggest that Midtown or a near transit corridor might offer a better value than ultra premium downtown condos. You can also consider alternative assets like purpose built rentals in some scenarios, multi units, multi families. Again, in this kind of category, the cash flow would be much more stronger than condos. But again, the ticket price or the price point to enter in this category is super high. For that reasons, you can also consider secondary or tertiary market if you're planning to be in selling invest. I do help my clients from GTA to invest in Waterloo region and surrounding because the price ratio is low over here compared to what you can get in GTA. So you can invest in a multi-family unit over here in which you may be able to have a good positive cash flow, or worst case scenario break even. And I always do this like a deeper scenario planning. Run what happens if the interest rate stays high for a longer time, or the rent drops by 5 to 10%, or your unit sits vacant for a month or more. This is very crucial for an investor to go through all these questions before jumping into the market. So, is it a time to buy a dip on Toronto investment condos? Now, my takeaway would be, maybe if you have a long term horizon, a solid buffer, and you buy the right unit in the right building at the right price. But for many investors, especially those who are depending on short term cash flow or expecting a rapid appreciation, the numbers simply does not make sense. If you would like to help running the numbers, comparing the neighborhood like Toronto, different neighborhoods in Toronto as well, or Toronto versus Waterloo, or just want to run down some numbers for an investment property, I would love to help you out. Thank you so much for watching. I will see you in the next one.